How to invest in winning stocks. A comprehensive guide.
This is a complete guide on how to invest in stocks in 2023. This guide is intended to help you choose the best stocks to invest in the market by looking at the main financial ratios and potential growth. It also helps you avoid hyped stocks, as we list the main patterns to identify red flags. Investing, trading, and gambling are all activities involving risk and reward, but they are not the same. If you're considering getting involved in any of these activities, it's important to understand their differences and the associated risks. Investing is a long-term strategy that involves buying assets with the expectation that their value will appreciate over time. Trading is a strategy that involves buying and selling assets to make a profit from price changes. Gambling is risking money or something of value on an uncertain outcome. Each of these strategies has its advantages and disadvantages, and it's important to understand which one is right for you based on your goals, risk tolerance, and financial situation. Investing your money can be a tricky balance between taking a risk and playing it safe. On the one hand, you want to diversify your portfolio to create a reliable and sustainable income stream. Conversely, you don't want to get too comfortable and miss out on potential opportunities. When you decide which stocks to buy, you need to find companies that you think will perform well in the future. You can do this by following a few different strategies. 1. Value investing. Value investing is a strategy that involves finding undervalued stocks. 2. Growth investing. When you invest in stocks based on growth, you're looking for companies that are expected to experience high levels of growth in the future. 3. Picking top stocks. Another way to pick stocks is to focus on stocks highly recommended by analysts. Let's now talk about how to choose stocks. What financial ratios should you look at when you pick stocks? What red flags should you avoid? When picking stocks, the two main ratios you should look at are the debt-to-equity ratio and the return on capital employed. The return on capital employed ratio calculates a company's profitability based on its invested capital. A high ROCE ratio indicates that a company is very profitable. The DE ratio is used to determine the level of financial risk that a company is carrying. A lower DE ratio indicates a lower financial risk. A DE ratio that's below 30 is considered acceptable. DE ratios between 30 and 40 are considered average, and DE ratios above 40 indicate high financial risk. Lastly, let's talk about red flags, those companies you should avoid investing in. Companies with high operational gearing should be avoided. Operational gearing measures the level of gearing, or debt, in a company's operations. It can help you to determine if a company is over-leveraged, and therefore, at a higher risk of bankruptcy. High debt and low interest coverage. A high amount of debt on the balance sheet could be a red flag if a company doesn't have enough cash flow to meet its obligations. A company with high debt on the balance sheet and low earnings may have difficulty making interest payments and paying down the principal amount. Lastly, you should consider industry red flags. When researching a company's industry, look for red flags that could indicate a decline in demand for the company's product or service. This could mean that the industry is maturing and could pose long-term challenges for the company. We reached the end of this video. I just wanted to remind you that this video is provided by Best Stocks. You can read the full guide on beststocks.com. Thanks for watching.